Hey, before we get started, I want to talk to you a little bit about our theme for this quarter, growing and protecting your portfolio. We're excited about various topics centered around this, but it really comes down to three concepts that will help you grow and protect your portfolio. You can find a PDF on our website about this. Go to wiserinvestor.com, scroll down to the bottom, enter your email address, and you'll get the PDF titled 3 Ways to Grow and Protect Your Portfolio. Thanks for listening. Welcome to a Wiser Retirement Podcast, where we cover financial topics such as retirement planning, tax planning, portfolio management, insurance, and estate planning, so you too can have a wiser retirement. I'm your host, Casey Smith. Guiding you to financial success are my co-hosts, Brad Lyons and Barnett. Hey, guys.
Hi, Casey. How's it going?
So today we're going to talk about what is portfolio diversification. How do we properly diversify a portfolio? And back in the day when I was still an airline pilot, I was on the Airline Pilot Association 401k committee, or as a 401k specialist. I can't remember what title they gave me. Anyway, not important. And so we would do workshops for the pilots and their families, and basically it was a day. It was 2 hours talking about Dave Ramsey, don't be stupid, don't carry credit card debt kind of stuff, right? Followed by lunch, followed by, okay, this is how 401k works. This is how you should be investing in your 401k. And at the time, inside the 401k plan, there was a large cap growth fund, a blue chip fund, and then there was the S&P 500. And I believe that there was a value fund. And one of the most common portfolios that I saw for the DIYers was they would kind of pick all those. But when you look at all those, pretty much the same thing for the most part, right? Growth is a little bit different, value is a little bit different, but it all matched the S&P 500. So I would say that portfolio was probably not real well diversified. Now, this was a long time ago. So at that time, other asset classes were outperforming the S&P 500, where the last 10 years, we have not seen that as much.
Or target date funds either, probably.
Or yeah, right, exactly. I saw that a lot too. I saw a mixture of all the funds and then target date funds added in there. And I had a whole PowerPoint slide dedicated. It's like either you're all target date or you're not. There's no reason that
mix and match.
You would have a mixture of everything and then a target date fund. But I think this is something that's not understood well. Another thing that I've heard, and Matthews, you and I experienced this with a person who came through our office one time, is they thought diversification was using different funds. So they were different fund companies.
Right.
So they were perfectly fine holding the exact same portfolio, but they want to hold it in about, it was like 12 different places.
There's a lot of different places because thinking, like with a bank account, you can keep certain amounts shielded for protection. They thought that having it at various custodians and broker dealers was diversification in and of itself.
So she had money at Merrill. She had money at Edward Jones. She had money. She wanted to add us to the mix.
Right. Vanguard, Fidelity.
Vanguard, Fidelity.
All the big names.
I think there's a T. Rowe Price fund in there. So, but it was basically the same portfolios at all those places. So she was not diversified, but we tried to get her to understand that she was creating a lot of administrative headache for herself for no gain. There was no gain for her whatsoever in doing this.
Yeah, there's a lot of overlap in each one of those funds that's within it. So it's either very undiversified and all tilted some way, or there's just a bunch of overlap that doesn't really make sense from a portfolio standpoint.
And what's funny, I thought was kind of humorous, is that she actually worked for a fund company. Like she worked for a mutual fund company, like administrator or something like that. And so even their own employees think that to be diversified, you have to have all these different. I never quite got to the bottom of that. I think something really bad must have happened in the past to cause someone to do that, possibly. But that's not diversification. That's just a lot of paperwork, a lot of headache, and a lot of statements. And when she passes away, a lot of administrative headache for her family is what that is. So there are some guidelines, but it seems like a really simple topic, right, Brad? But it's not so simple because then we have to now explain it. We know how to diversify our portfolio. We know how to run down the list and kind of go, I should have this percent here, should have this percent here. And so we're trying to figure out what's the core to all that. How do we explain that to people, and how do you allocate? And it comes down to something that you can Google fairly easily, maybe learn more about it, but it comes down to modern portfolio theory, right?
That's right. And modern portfolio theory has been around for quite a while. A gentleman by the name of Harry Markowitz came up with this idea. And back in the 50s, he did some research on asset classes and portfolios and combining asset classes within portfolios in order to determine at what level do you get the maximum return for any given level of risk that you're willing to take. And how do you blend and mix, or the word is called optimize, a portfolio in order to achieve that result. And over time, this became, accepted in the investment community. It came out of academia, and it became, accepted within the investment community, and it gained momentum and steam and over the years. And now it's just become part of the fiber of investment management. And so you say, we think of it all the time, but how do we explain it? It's just something that we do, and we know, and we recognize that modern portfolio is just part of the building blocks of portfolio construction. It became so popular and so well known and so appreciated, I will also say, that Harry Markowitz won a Nobel Prize in economics for it. So it's not just a fly-by-night thought or theory. Right. It's basic investment management principles.
And there's been different versions of it that have been created since then.
Yes, there have.
But it goes back to that's the basics. And everything else that anybody else has done has built on top of it, not really taken away from it.
That's correct. It's all about recognizing the risk and return model that exists in all of investing. Okay? For every investment, there's a given level of risk that should be expected. For every level of risk, there's an expected return that an investor should get. It's blending these two together and optimizing them in a portfolio for you to achieve your return that you need, okay, without taking any more risk than you need to take in order to get it.
So it's kind of like, I like lists and charts. Mm-hmm. So if you listed out all of your investment options, and if you thought of them in terms of asset classes like large cap U.S., mid cap U.S., small cap U.S., developed foreign, emerging markets, and then U.S. or global real estate. So you think about let's just talk about stocks right now. Bonds, it gets a little more complicated, but so just in stocks, if you listed those out, and then you had a rate of return expected from that, and then you had a standard deviation, meaning its volatility, right?
Mm-hmm. The deviation from the expected return. Yeah.
So you can find that for an investment very, very easily on Morningstar has it. I think even ETF.com will show Sharpe ratio, or not standard deviation, and obviously they have rate of return there. So if you think about small cap stocks, are supposed to have a slightly higher rate of return than large cap stocks with more volatility. Mid cap would be the same way, higher rate of return, more volatility. Then there's large cap, which is, it's given rate of return with its volatility. Then you have the same thing for foreign. Emerging markets are going to be really volatile, and you should expect a higher rate of return from that. So obviously, if you went down the list, which is what people do in their 401ks all the time, because they don't give you any tools to analyze a 401k plan, they just give you the rate of return. So we're all chasing the hottest funds inside the 401k plan.
Yes, we're all looking in the rear view mirror as we're driving down the road.
So what you would do is you would take off different pieces of the pie and say, okay, man, emerging markets, I know that could give me a 20 or 30% rate of return, but I'm taking this 60% deviation. So I'm going to put 5% in there, because that could give me big rate of returns. But on the downside, I don't want to have 50% of my money there. And then on the other side, S&P 500 is going to look pretty conservative in comparison. So you might have a larger allocation to more developed companies on the top end, right? So basically you're just going through this list and you're on allocate different percentages to each one, with the super risky being a smaller percentage of the portfolio and the less risky for the stock being a larger percentage, which would be U.S. large cap.
Right. And I'm glad you used the term more risky and less risky, because there's risk in all the investments. And utilizing a concept such as modern portfolio theory, which actually encourages more risky assets in a portfolio, because when you blend risky assets with less risky assets, you're changing the dynamic of the portfolio, not just in its absolute return stream, but in its variable return stream or periodic return stream that goes along with any portfolio, meaning that not all assets move in tandem with one another. Okay, so it's not just that it from point A to point B, they're all going to return what they're expected to return, but within point A, B, C, D, E, and F in different time periods, these assets are going to move independent of one another, okay, to produce their overall return stream. That gives the portfolio an overall smoother, okay, return stream, creating a higher predictability or probability of an expected return. So it's really, it's utilizing the risk measure in every investment in order to create this portfolio. It's not avoiding risk, it's managing risk, with relative one to another in an investment type, large cap U.S. stocks versus small cap.
In a normal market environment, going back to correlation, in a normal market environment, things are going to move up and down at different times. So
That's
small
right.
caps, mid caps are somewhat correlated with large cap, but real estate shouldn't be. Your real estate portfolio might be kind of out there doing its own thing, right?
And you look for that sort of investment opportunity within a portfolio so that you have non-correlated return streams within a portfolio that has a correlation itself.
Right.
So modern portfolio theory also uses something called the efficient frontier or line, I think it is, efficient frontier line. And that's an upwardly sloping curve that says at any level of risk and return on a chart graphed X and Y axis, what you're going to find is on this curve, this efficient market line, is a level of risk and an expected level of return. So as an investor, you would look at that line and say, all right, I need X amount of return. This is how much risk I'm going to have to take. Mm-hmm. Or vice versa. I'm only able, okay, to take on a certain amount of risk. It's just based on my risk tolerance, based on my needs. So I should only expect a certain amount of return, and I'm going to have to budget myself within that expected level of return. So it's used from both sides, risk and return, to construct a portfolio along the efficient frontier. Okay, anything under the line means that you're taking on too much risk and not getting enough return.
Right.
And so you always want to push yourself in your portfolio up to the line. And now this is not something that, as an at-home investor you could necessarily do. You can find, charts that show the efficient frontier. Okay. Then it's a matter of utilizing expected return ratios, standard deviations for risk, and creating a portfolio in order to get as close to that line as possible.
It's if there could be a slide, kind of like a slide, if you move it up, you have a higher rate of return, but then you see, the squiggly line start increasing. That's all the volatility in the market.
Right.
0% stock is not your least risky portfolio.
That's correct. And that was my point earlier. By introducing risk to a portfolio, risky investments to a portfolio, you actually can lower the overall risk of the portfolio over periods of time.
Right.
Okay. So
yeah, it's like 20, I think it's around 20% stock, 80% bonds. It shifts a little bit. It could be 25, it could be 22, but somewhere in there is the least risky portfolio. So
right.
the efficient frontier is kind of like a leading edge of a wing. Kind of has that shape to it.
Yes, it does.
So kind of flat on the bottom,
right,
curving up near the top. And so the least risk is going to be just at the very front of that bottom curve, and that requires some equities in the portfolio.
Yes, it does.
Where the highest rate of return is not always 100% stock. It's actually, there's like, anywhere from 10 to 15% bonds in the portfolio give you the higher rate of return on the other end, which I think surprises people. But there's just enough bonds added to kind of take off that rough edge of being 100% stock.
Right. We haven't talked about fixed income yet in this conversation, so this might be a good time to bring it in. And that there are so many different kinds of fixed income instruments out there, and each one has their own unique risk return, relevancy in a portfolio. They're all paying a different rate of interest. They all have different maturities. They all have different issues within the capital market structure of the corporation that may have issued them, and so they have different risk return analysis applied to them. And utilizing those types of instruments in a portfolio blended with equities or stocks, you can raise the amount of risk and return, or you can lower the amount of risk and return by utilizing a completely different asset class in a portfolio.
Yeah, and not all bonds are the same.
No, they're not.
You could probably have a little tangent here. So when it comes to bonds, I believe, and obviously I think we all agree here at this table, that bonds should be put in place not for the income necessarily, but just to stabilize the stocks. Because our growth in income is really coming from the stock side now in this low income environment. Mm-hmm. So when you think about risk, so let's go through I might miss a few, but let's think about the most conservative bond fund would be what? Short-term treasuries, right?
Right.
Then from there, it'd be intermediate term treasuries. Then you have corporate bonds. So a short-term corporate, or no, let me go back. So you have treasuries, followed by treasury inflation protected bonds, followed by mortgage-backed bonds, because those are still backed by the government, right? Then after that, we would go to, short-term corporates.
Right. Investment grade.
Right. Then you get, so the longer maturity that you have, the more risk you have in bonds.
Right.
So anytime we go long treasuries or long corporates, there's a lot more risk there.
Right.
Then after that, you're starting to get into high yield bonds. And then beyond there would be third world country bonds. So there's Russian bonds, and the emerging market bond fund probably aren't doing too well right now. Right? So we avoid high yield and we avoid emerging market bonds.
Right.
We do have a few portfolios, I think, with high yield in them currently for strategic reasons, but in our mass models or core models, we don't carry any of that. And then emerging market bonds actually have, and it's been probably a year since I've analyzed this directly, but they had just as much volatility as U.S. small cap stocks. So I just assume own U.S. small cap stocks as opposed to emerging market bonds.
Well, high yield also is very correlated with the stock market. So like you said, the whole point of bonds and diversification is to not have the same correlation. So it kind of defeats what you're trying to do with the point of the bonds being your kind of diversity away from equities.
Right. So I
would think that most people who invest consider bonds to be rather ubiquitous, right?
Right.
Pays interest, you get your money back at some point in time in the future. And that's about that's about all they think about. Right. Bonds are a very technical instrument that are used by investors for specific purposes. Yeah.
Right.
Yeah.
So stay away from the risky bonds. We only use conservative bonds in the portfolio.
Absolutely. Investment grade.
Yeah. That's their purpose. If you want to take more risk, then go buy equities, go buy U.S. large cap stocks. It's worked out much better for you.
That's right. You have it inherently in your portfolio if you're investing in those types of securities, but you're not getting paid for it. This is something that we've talked about in another podcast, the Sharpe ratio. Are you getting paid for the risk you're taking?
Right.
So if you're taking the risk, you might as well get paid for it.
So the point is that you can diversify risk amongst stocks themselves through those different equity asset classes we talked about at the beginning. Or if that's too much risk, then you start adding in fixed income or bonds to the portfolio. And that just depends on where you are in life. If you're 20 years old, you should be 90 stock, 10% bonds. If you're 40 years old, then you might be something closer to 80-20 might be your allocation. As you get into your 50s, early 60s, it's got to come on down close to 70-30, then eventually 60-40. 60-40, that's a great retirement portfolio, I think. 60 stock, 40 bonds. And then in this environment, it's really hard to get more conservative than 60-40 unless you just can't handle the volatility because of what the headwinds that bonds have going forward. But then your allocation could drop all the way down to as much as or a little as 45% stock, and you should be able to still make a financial plan work, a retirement plan.
Right.
Below that, right now, that I kind of question. Has to be a good reason. Be below 45% stock, I feel like, in this environment, unless you're just not sleeping at night. Right? There's a sleep factor. If you're not sleeping, then we got to make changes to the portfolio.
Right. And part of diversification isn't just to manage the percent risk. It's to manage the person's individual risk tolerance for seeing the numbers change in their portfolio. Remember, the larger the portfolio, the larger the magnitude that the percent represents. So a $100,000 portfolio, if it has a 10% downward movement, it's $10,000. And that $1 million portfolio that has a 10% downward movement, that's $100,000. So you're not just managing the percentages at this point. As the portfolios get larger and larger, and this is something that you were alluding to, Casey, a 20-year-old may not necessarily have that $1 million portfolio just yet because they haven't had time to accumulate it. They get to 40, they're getting to $500,000. They get to 60, they're getting close to that $2 million portfolio in their 401k. Now the magnitude of the changes that occur in a portfolio based on the risk that's in the portfolio needs to be managed as much as the percentages themselves do, okay? Because you're also managing the behavioral aspect of the investor, right, Matthews? And we talk a lot about behavioral aspects of investing.
Yeah, which is it's tough to quantify besides taking like a risk questionnaire or something like that. But like we mentioned, when things are great, everybody wants to be invested. But when things are bad is when you actually behaviors get in the way and you start to question your allocation. And one of the worst things you could do would be to go to more bonds or go to cash when the market's down, rather than just maintaining a allocation that you're comfortable with for the long term and just letting it ride and toughen out for a little bit.
It's but still though, we go back to what's the best way to build an asset allocation, and there's templates out there. Vanguard has some model templates. I don't know if they're available to the public or not.
I think most of them are now.
There's obviously BlackRock has some templates that are out there. Those tend to change a lot. They're not day trading, but they're like quarterly trading. they'll just remove whole funds, which is kind of frustrating. State Street, I know, has some that are sitting out there. So it gives you kind of a template to build off of to say, okay, I'm aggressive allocation. How does an aggressive allocation get allocated amongst different asset classes? And that's what you can go and build a portfolio with. In the last 10 years, we talk about this all the time. The S&P 500 has been really hard to beat over the last 10 years. So if you just dropped it all in the S&P 500 index fund inside your 401k plan, you turned out pretty good. But there are going to be days like maybe the time we're living in right now where you don't like seeing that drop, and that's where you're going to want to add fixed income. Not now. you would have added fixed income before the drop, right? So sometimes you have to kind of weather the storm. Don't be moving asset classes in the middle of a crisis. You do that near the market highs or in a normal market environment.
Right. And when you diversify, you also recognize that you're not always going to have all your money in the best performing asset class. But if you're diversified well enough, you always have some of your money invested in the best performing asset class.
That's true. I think that's a question we get, I wouldn't say a lot, but more often these days is why do I have these 4 funds in my portfolio that keep losing money every month? And when they say keep losing money every month, typically it's a small percentage wise compared to the overall portfolio. Well, it's because you're diversified. That's why you have it in there.
Right.
Yeah. Michael Kitces has a good quote where he says, diversification is always having to say you're sorry, because if everything was always up and pointing the right direction, then it's not diversified.
Yeah. True. Things move at different times for different reasons.
They do. But
Again,
it gives the portfolio an overall smoother ride.
Again, Susie Orman and all the people saying to get rid of your bonds last year. If anybody actually did that, you're probably glad you had them right now. So that's why I was a finance major in school, because in accounting, it's a square peg, square hole, right? But in finance, it's an art. So there are a lot of different ways that people try to slice and dice portfolio creation, right?
Yeah, there's both art and science to this.
So it's in the index world, it's really simple because, I say it's really simple. It's simpler using index funds, using ETFs, because you know what is inside that ETF, and you know what's inside your portfolio. If you go and you're using mutual funds, so if you're at a brokerage firm right now and it says large cap strategic fund or something like that in the description, there's probably a chance that there's mid cap, small cap, maybe some foreign. You don't know exactly what's inside that mutual fund because the fund managers have leeway to do whatever they want, right? So if you really want to know how your portfolio is allocated, Vanguard Morningstar does a really good job at this. So you log into Morningstar, you go to morningstar.com, sign up with an account, you put your portfolio in, and then you run this X-ray report. The X-ray report will tell you exactly where all your assets are by asset class, right? And so that will be probably eye-opening to a lot of people who don't have ETFs or aren't using index funds. So they'll find that they probably have more tilt toward riskier asset classes than what they were expecting, simply because the fund manager is trying to keep up with the competition. And so what they'll do is they'll throw in more riskier investments into the portfolio to get a higher rate of return, right? And in reality, it's your large cap fund ends up being an all cap fund in the U.S.
Well, when we utilize the ETFs that track an index, what we're also utilizing is not just the investments in it, but rather the index that's associated with it and the asset class. And that asset class has decades of return history,
Right.
Okay, associated with it. The active fund manager probably doesn't, okay, because they're constantly changing their portfolio. And so the historical aspect of it may include manager who started at one point and then retired or moved on. The next manager came in, the next manager, and the next manager. Right. And through different market cycles, each one acted in a different manner and invested in a different manner. Whereas the index was always the index. And so the probabilities that we utilize in creating a portfolio or constructing a portfolio become very important. And by utilizing the index or the ETF that tracks an index, we create portfolios with a higher probability of success given the diversified nature of them.
And it gets harder because if you're using a brokerage house, a lot of them have kind of gotten away from mutual funds or using individual stocks now. So like their own separate managed account. So when you open up your statement, you see 100 stocks. That's really hard to track that at home. You'd have to go literally input the entire portfolio into a Morningstar in order to figure it out. Right. Hopefully they could just run a report for you. Say, could you give me an asset allocation report? But and it doesn't mean that any allocation is bad necessarily. It just helps you understand where the returns are coming from, and this goes back to our last podcast. Could a very simple portfolio, all world, all U.S. bonds, actually beat what appears to be a very, very complicated strategy, right?
Right. Because they can get so diversified that they have very small conviction of each one of the securities that's in the portfolio. We see lots of portfolios where there are so many positions, as you mentioned, Casey, but they only have a 1%, 2%, 3% allocation to them. That stock could double, triple, and it doesn't move the needle.
Yeah, right? It's not very efficient.
No, it's not.
Yeah. I see. We see that. 1%
more
or less, 1% or less allocation.
Yeah,
I think it has less to do with rate of return, has more to do with big brokerage, big box advisory groups getting rid of the mutual fund guy, doing it in-house, and then keeping that margin has more to do with money than it does with asset allocation necessarily.
Complexity too. Sounds good. The more accounts you have, but like you said, if it's not, doesn't mean necessarily more diversification, less risk. So could not be really a good reason to be utilizing it.
Smoke and mirrors. Okay. Well, guys, I wish that we could just give our listeners, if you're this age, use this allocation exactly. And it's not that clean. We have benchmarks. We have allocation benchmarks. We can see what the world's doing with these allocations, with their allocations, and we can kind of shift ours based off of that. Mm-hmm. We also look forward. And expected rate of returns for different asset classes and building our allocations. But for a DIYer at home, it's not simple. You need to have a strategy. All right, good chat, guys. Talk to you next time.
Thank you.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening, that way you don't miss any new episodes. We would also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. We would love to hear from you. This episode was produced and edited by Lilton Moore.